Hello, and welcome to tonight's webinar, AAII plus Better Investing, Your Stock Strategy Edge. So my name is Jennifer Scheer, and I'll be your host for tonight. We're just going to get started right off the bat, but we're thrilled to have you here. Today's session is led by John Bajkowski from AAII and Doug Gerlach from Better Investing. As a thank you for attending, you'll get access to special membership offers from both AAII and Better Investing, and then so details coming at the end. And a few quick notes before we begin. I want to remind all of our webinar viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus is not able to give personal advice. And then please keep an eye on your chat section throughout the webinar for helpful resources, key information, and of course, some special offers. And you can submit your questions anytime using the question section of your GoToWebinar control panel, and we'll answer a few live at the end. And then you'll find slides in the handout section. These will also be emailed to you along with the recording later this week. And if you have any tech issues, please visit support.gotowebinar.com for help. And before we get started with our presentations, I'd like to briefly introduce our speakers. So John Bajkowski is the president of AAII, and he is the lead analyst for the Model Shadow Stock Portfolio and Stock Superstars report. He's also played a key role in developing our Stock Investor Pro. He has over 30 years of experience studying all facets of investing, from quantitative stock screening to mutual fund analysis to portfolio strategies, and teaching individual investors how to reach their full potential. And then joining us as well is Doug Gerlach from Better Investing. For more than 30 years, Doug has been helping individual investors make smarter investing decisions. And then within Better Investing, he's been an investment club member, volunteer national advisory board member, website and software developer, and now full-time staff member of BI and its ICLUBcentral subsidiary. He's also the author of 6 financial books and editor of 3 stock newsletters, the award-winning Investor Advisory Service, the market-beating Small Cap Informer, and the newly launched Dividend Informer. And Doug has presented at hundreds of online and in-person events around the world, including at AAII and BI local chapter meetings and national conferences. And now that you've met our presenters, I'll hand it over to John to get us started.
Well, thank you so much, Jenna, and welcome. And welcome, Doug. It's a pleasure to be here with you. We got together virtually over the phone a couple months ago, and we thought, what a great way to get together. We're 2 nonprofits with a similar mission of helping individual investors reach their financial dreams through programs of education, information, and research. And one of the things we thought that was a great connection between our organizations was this desire to instill a disciplined approach to investing. And we have many members of both sides that are both stock investors. And we thought, well, why not illustrate some of the tools that both of our organizations offer that can either help identify some candidates that are promising and also do some analysis on those candidates to see if they actually make sense to buy and sell. So we're going to break up our presentation tonight in 2 phases. I'm going to do the first phase, in which I actually take a look at the stock screening resources on the association and highlight how one can go ahead and pick a strategy, how one can perhaps do some quantitative filtering, come up with a list of small candidates, and then Doug's going to take it away and illustrate the tools that Better Investing has to go ahead and do a deep dive on a company. Did I get that right, Doug? Any observations before we get moving?
No, I think that's a great characterization. I'm looking forward to tonight.
Same here. Well, with that, I'm going to go ahead and see if I can go ahead and start sharing my my screen here, my slides. And my focus is going to be in the area of stock screening and stock analysis. And stock screens can really help you organize, analyze information in a disciplined fashion. I'm going to highlight the benefits and some of the limitations of screening, how to select an approach by looking at the tools of the association. And with that, I'm going to get right in here and the benefits of stock screening. I think the key element, one of the key elements of successful long-term investing is having a disciplined approach in place. And with a stock screen, you're basically taking a large universe of stocks, trying to filter it down to a small segment of companies that have the kind of qualities you think are worth investing in. And it adds a level of discipline to you. It also allows you to go ahead and avoid wasting time on companies that have no interest to you at all. I mean, the key is a discipline and having a set of benchmarks to analyze not only stocks you want to buy, but also stocks you might want to sell. Too often we're bombarded with ideas in the marketplace, and we need some sort of framework under which to analyze those companies and how to select them. And I think stock screening, once you identify the kind of companies that really you want to deal with, are a great way of just narrowing down that universe to a small select set of companies that are warranted of further deeper look. And there are always, any kind of quantitative methodology, always dependent upon the quality of the research and the quality of the data that's underlying that information. So it's important that if you do any kind of filtering using any systems, ours, BetterInvesting, or a third party out there, that you understand that they are using a good quality source. That information needs to be verified and it's consistent across companies. So that's one important consideration is no matter what, you're going to find some data errors probably that occur, or some mischaracterizations, or understanding is perhaps a foreign currency been translated properly. So there's going to be some dependency on the accuracy of that information. And also, when we're talking about stock screening, in this case, it's a filtering process. It's really quantitative in nature. It doesn't have the qualitative elements to it. So you're possibly going to miss some opportunities that are just going to be outside the very specific limitations of your screen. You might be screening for low PE stocks that have a PE below 15. Well, if a stock has a PE of 15.1, it's not going to pass. Doesn't mean it's not a good quality investment, but it may just be outside that particular factor. And also, we're so comfortable, I think, investing in stocks we know. A stock that comes across the newswire, you pass a screen, all of a sudden your eye probably going to go to the company that you understand. But really, you want to take a look at the full range of opportunities that present themselves, make sure they're diversified by industry. So sometimes by just stock screening, you're going to be forced to do some deeper analysis, perhaps invest in some opportunities that you're not quite familiar with as far as what they might be. So the key part here is it's a process. And the first part of that process is identifying a philosophy that you can live with over time. And there are many different successful strategies out there. Some are growth focused, some are value focused, some are growth at a reasonable price. But the key is to understand, what market segment you want to invest in, be able to invest in that market segment through good times and bad. Because the worst thing you could do is pick out an investment style in which you can't handle the risk that goes along with it. If you're going to be looking at a momentum investment strategy, probably going to be a higher turnover, going to require you to look at that portfolio more frequently and perhaps turn it over more frequently. So understand the limitations and make sure the style of the investment analysis matches up with your investment style, your time commitment, how you want to invest in companies, what you believe in. If you're a bargain hunter, perhaps value is the way to go. If you're looking for momentum, then obviously that's a different type of approach. So really, it's important to really find a style that matches up with you and understand that no matter how good the screen, it's a starting process. If you're going to narrow your list of companies down from many to a small number, you want to do some deep dive analysis on those companies, make sure they match up and they passed for the right reason. When it comes to what we do at the organization, at the association, over the years, we've really focused in on looking at how various successful investors have done and taking their teachings and trying to develop them into specific quantitative stock screens. And over the years, we've analyzed many different gurus, Peter Lynch, in some cases direct works by the people like Peter Lynch, in some cases indirect works. I mean, there's many articles and books about Warren Buffett, but he hasn't really written any specific books on how to invest his way. We've taken these methodologies, these philosophies, and distilled them into quantitative screens, try to capture the investment approach of these gurus. In other cases, we've simply taken standard procedures or standard methodologies for screening, perhaps low price to book or price to sales, and developed a full focused approach, the primary factors, secondary factors, conditioning factors to kind of match up with that style. And what we do is we actually track these screens online. We present them to our members, and members can go ahead and actually track them online. Now, on our website itself, we have 3 different types of screens or screeners available. Our focus site is going to be on the primary AAII predefined stock screens, these 55 strategies that focus on how to invest using different kinds of guru or factor approaches. There's also other additional screens that we have on our website, things that deal with a custom stock screen. You could enter your own filters, and also grade screener, which is allowing you to take a look at specific grades or factors such as growth, momentum, earnings, quality, and do some finagling or screening in that context. Our focus today will be on just the primary screens that exist on our website, the 55 basic ones. And the best way to get to that area, if you log into our website, is to really go to the stock under the stocks area, go to the stock ideas segment, and it takes you to this main menu here that allows you to go ahead and see the different tools that are available for stock screening. What I like to do then in that context is try to go ahead and when I'm in this area, maybe one popular approach is to take a look at our stock screen power rankings. And it's just simply a way to go ahead and take a look at all the 55 approaches that we have that are all different, and perhaps rank them or sort them and see which ones are perhaps either doing well long-term or doing well in the bull market or bear market, or perhaps are lower risk. What I did in this particular context is actually look at that risk-adjusted return. I wanted to take a look at the screening strategies that have a good long-term track record, adjusted for their risk, with the understanding that some strategies that are more volatile may have a longer rate of return long-term, but that comes with greater volatility year to year or month to month. And we adjust for that particular volatility to put them on an equal footing. So I simply took a look at the strategies that have a good long-term track record. I wanted to take a look, sure they're risk adjusted. And I kind of scanned through that list and kind of found an approach that kind of mirrors up with how I like to invest. And I'm kind of a contrarian investor. So in this case, number 9 on the list was dreaming with estimate revisions. It kind of spoke to me. Very much a dream. He's a contrarian, likes to look at stocks that are cheap, not too cheap, that have a record of improving earnings, are paying a dividend, are smaller to larger, kind of matched up with the investment style that I'm looking for. And one thing to note is when you are looking at our various strategies, you can go ahead and favor them or check mark them, and then they'll be tagged as a favorite. And I'll show you later, you could then go ahead and just look at the companies that are passing your favorite screens at a point in time. In this case, for every screen that's in our system, we break it down into 3 chunks. We have the basic long-term performance thing, which again, everyone wants to focus on performance, but I like the story. So we always make sure that we do a deep dive as to how we built the screen. What was the philosophy of the investor behind it? How do we take these sort of qualitative factors and turn them into specific quantitative rules? So for every strategy that we have out there, we try to explain the philosophy behind it, how one can go ahead and build the specific filters if you want to do it on your own. But it gives you a sense for what kind of factors are going to lead to making the stocks pass this particular screen. And it's also, when available, what kind of factors would make you want to sell the stock when it no longer is attractive. Probably what most people all of a sudden go to are these companies that pass. So in this context, what we have here is the Dreamin estimate revision screen. So it's a contrarian screen. It has an additional qualifying factor. These are companies that have had recent earnings revisions upward. So they're beaten down stocks. They're a little bit larger. We look for a minimum financial quality, but they have in some context some improvements where all of a sudden, they're outperforming what the market expects them to do in terms of analyst revisions. Analysts are looking at forward, and they're actually boosting their earnings estimates going forward. So in this case, as of yesterday, we had, I believe it was 1, 2, 3, 4, 5, 6, 7, 8, 9 companies passing this filter. And you can take a look in this context, which companies are passing. If any of these speak out to you, perhaps you need some diversification. In this case, this happens to be sorted by dividend yield. The highest yielding stock that passed this filter is T. Rowe Price, has a yield of 5.4%. Interesting, if you look forward, it actually is, we have expectations for earnings to actually dip down this coming year. So we have historical earnings that this should be 9.20, but we see analysts expect earnings to dip this year and then start to rebound slowly. Might be why its PE is a little bit lower, why it's beaten down a bit. And then if you want to, you can go ahead and in this context, click on the plus sign next to a stock. It'll be added to your portfolio. And that gives you ability to, or it could be a watch list, it could be something you own, but ability to track that group, track that stock, look at its news and whatnot over time. So that's one way that people want to find screens that are of interest. But another tool that really a lot of our members like to go to is the all screens display. And if you go back to that stocks drop down and pick the all screens area, it takes you this list of all 55 strategies. And again, performance is here, and you could download a spreadsheet and do kind of ranking. But what I like to do is look at the characteristics of these particular strategies. And in this context, I clicked on the characteristics tab, and I could see now, on average, what is the price earnings ratio of the stocks that pass a particular strategy. I can click on a plus sign next to a strategy and look at the stocks that make up each approach. So I get a sense for, if I'm looking for an approach, am I looking for something that's going to be smaller cap, or is it smaller cap? Does it have typically high price strength? Does it have price momentum? Are the stocks paying a dividend yield, like the ADR screen? On average, median is dividend yield of 0. So you get a sense for the kind of qualities that each stock strategy has, and you can perhaps find one that matches up with your personal investment strategy. And you could then dig down and see which companies pass currently. And again, if you favor these particular strategies, be able to do some additional analysis on those down the line. So it's a good way to, again, compare and contrast the different approaches and find one that really sings to you. You could track it for a while, get comfortable with the strategy, comfortable with the stocks that pass it. The other approach you can get, other element that's available on this particular element here, is the grades tab. And grades is our attempt to go ahead and quantify a stock based upon certain basic fundamentals, value. And we use a wide array of value measures to measure that or grade that: price to book, enterprise value, shareholder yield, the consistency of its growth over time, how well does it compare, momentum, is it showing price momentum, does it have earnings revisions, and financial quality. So these are all ranked within the overall universe, and grades that are higher, like in your classroom, have a higher, more desirable quality in that regard. Although it can be a challenge to typically, if you want high value and high growth, that can be a challenge. So sometimes it's a factor of doing some compromises. But you can look at the typical grades that pass on average. And the Dreamin with estimate revision screen has a median grade of C. And you think, well, this is a contrarian screen. Well, the thing to consider about the Dreamin approach is that he looks not for the lowest, necessarily the lowest price to book stocks. He looks for stocks that have a lower than average price to book, but are exhibiting other financial qualities that are positive. So again, if you want the cheapest of cheap, you might not look at this particular approach. You might find it something else. But it'll give you a sense for the particular qualities. Does it have earnings momentum, growth? And you could go ahead and do some deeper dive on those particular approaches as you go on. And once you favor a specific approach and you go ahead and do a price to cash flow or a Dreamin estimate revision, you can, one thing that I find very helpful personally is once you start favoring these screens, these approaches, you can go to the My Stock Screens area, and there's a couple of different ways to get that. It's on your home page. It's also available here in this Tools dropdown. If you click on My Stock Screens from the drop-down area, again, it gives you a quick way to just filter your chosen screens, see which companies are passing that particular screen, but then do some deeper dive on that. But one of the things I like to do in that context is look at some of the tabs that are on here. And again, you can look at the grades, the stocks. So if you have favorited, a couple of value screens and you want to see which stocks pass all them in one easy spot, this is where you can do it. But I find more interesting even is to the extent that you have gone ahead and saved stocks over time into watch lists, and you want to understand which, if any, of those stocks are currently passing a given stock screen, you can go ahead and actually look at this stocks passing any screens. These are my stocks. So I'm a little bit, I guess, unusual. I've created some bigger portfolios, in some cases, portfolios of things that I'm tracking. In other cases, I've actually just simply gone ahead and created some portfolios that are just simply part of what stocks make up the S&P 500 or the mid cap. But what this shows me is that of all the stocks in my portfolio, and I've got a lot of stocks that I'm doing some deeper analysis, it's telling me that this stock particular is passing 6 different screens. So Comfort Systems USA, which is in my S&P mid-cap portfolio, is currently passing the Buffett-Hagstrom screen, the Buffettology EPS screen, PE relative screen, return on equity screen, value on the move. So it gives me a sense, okay, this is very much a value-focused approach. And I get a sense here for what kind of companies that I'm tracking, what screens are they currently passing, and is there some pattern there that's worth noting? Granger is in my Dividend Aristocrats approach, and it's passing the Buffettology, 2 of the Buffettology screens, PE relative screen, as well as return on equity. So it gives me a sense for the kind of approach one stock may follow in terms of having more than one screen approach. And I find this kind of an interesting way of creating a watch list of stocks and then tracking to see what screens it currently passes and if it's worth doing some deeper analysis on that particular approach. The last real kind of an interesting tool that I want to focus in on that I really find useful, and if you're not sure, what approach is right for you, and perhaps you want to be a generalist, you simply want to get a sense for, okay, well, I don't know, I'm not sure what's the difference between Buffettology and stock market winners. I kind of follow those both kind of approaches. I could simply take a look at which stocks are all stars, which stocks currently pass as many screens as possible. So if you go to the My Screens thing and you click on stocks passing multiple screens, this now ignores any specifically saved portfolios. It takes a look at the complete stock universe, all publicly traded stocks in the US, and it allows you to pick, well, I want to look at stocks that only pass, in this case, 5 screens. They have to pass at least 5 screens. And right now, there's only 7 stocks out of the 6,000 or so publicly traded companies in the US that currently pass, actually 7 stocks that currently pass at least 5 of the AAII predefined screens. And I go, that's interesting. That's an interesting place to look. And I could take a look now and get a sense for, okay, which screens do they pass? And maybe this is a way that I can go ahead and do some deeper analysis. So in this case, I've got AAII Limited, passes 5 screens, passes the Lynch screen, which is kind of a growth at a reasonable price type of screen, passes the price to free cash flow screen. So it's got pure value. It's generating free cash flow. That's interesting. And it's priced cheap based on that key free cash flow. Again, price to sales screen. So it actually has a attractive valuation based upon its price to sales ratio. So it's both bottom line, top line profitable and interesting. Value on the move. It's a PEG ratio. So it's got a PE to growth ratio that's attractive. And it's actually showing some price momentum. On the move part is the price momentum part of it. Now, I don't currently have it in any portfolios, but this is a stock that might be interesting to do some deeper analysis on. And this is the kind of way that you can go ahead and use some of the screening tools to find stocks of interest. And I think later on, Doug is going to give us a deep dive on this stock here, I think using the SSG methodology for doing a stock analysis. But just a quick summary here. And again, I've gone pretty quickly, but I've given you a good overview of some of the screening tools on our website, hopefully wet your whistle as far as the kind of approaches that are out there and how we can find some ideas. And again, it's very important to understand that when it comes to stock screens, you want to find a philosophy that you believe in. If it's value, understand that sometimes you have to be careful about value traps. You want to have some secondary filters that make sure the stocks that are passing are cheap, but they're cheap for the right reason, and they're going to probably bounce back up. But you understand that value may take a while to come back. It might be lower volatile. If you're looking for more earnings momentum, earnings growth, more aggressive screens, probably going to require closer maintenance. And any screen, any approach is going to have periods of underperformance and outperformance. And the worst thing you could do typically is jump ship at the wrong time. So you want to have some belief, understanding, and some discipline in that process. And again, it's just understanding that no matter what, every screen is a first step in the process. And typically, the fewer stocks you hold, the more deeper your analysis has to be. If you're holding many stocks, hundreds of stocks, perhaps you could be a more cursory in your analysis. But when you start holding a small number of securities, you want to do a deep dive of that analysis and that's concerned. As far as what we have and members have, just a quick adjustment here. So when it comes to the approaches I've described today, all the screens, these are things that all association members have access to. You have access to all the guru screens, the historical performance, the ability to save and vet these screens and factor them, look at them in the My Screens, the power ranking. So all the basic access to the predefined screens are part of membership. If you want to get involved into custom screening or do deeper analysis on the factor screening, that's part of a premium offering. But that's a quick rundown. And hopefully I've provided enough interest to try to take a look at one of those stocks. Doug, I'm not sure if you're there and you're ready to go, but if you are, please take it away.
Thank you, John, and welcome everyone. It's great to be here tonight. As John mentioned, I took a look at some of the stocks that passed his screen, and there were a couple of interesting ideas. I thought some of the stocks that we cover in our stock newsletters are passing those screens. Some of those companies were a little overvalued, perhaps, according to our growth at a reasonable price approach. But I did decide to do a little bit deeper dive into AAII, which is a company I'll tell you about. Before we get started, I did want to remind you that this is an educational presentation and we're not providing specific investing advice. And we always suggest that all of our members and participants in our events do their own analysis to make sure that any investment is suitable for your personal portfolio. Now, at Better Investing, we use a tool called the Stock Selection Guide, or SSG. And this is a tool that was developed a long time ago and really is meant to provide a disciplined approach to individual stock analysis based on fundamentals. I think, as John mentioned in his presentation, discipline is really key when you're investing in individual stocks or any type of security for that matter. The Stock Selection Guide helps average investors focus on those attributes which are most likely to contribute to the long-term success of those companies. It borrows a lot from business school studies and textbooks. It borrows a lot from some of the greatest minds of investing, principles that Warren Buffett and Benjamin Graham used, and all the way down to Peter Lynch and his adherents. It is a long-term buy and hold based approach, but that doesn't mean buy and never sell. And it does acknowledge that there is risk in the market. A lot of people who are selling you ideas and stock ideas tend to downplay the risks of investing in individual equities. But we focus on long-term, which means through each economic cycle, through each bull and bear cycle, and look at the long-term potential of companies. And this type of methodical approach, we think, helps you reduce the risks of mistiming, buying at the wrong, when the price is too high, not when the opportunity is there that gives you a maximum rate of return, or knowing when to sell when a company's fundamentals are not performing well and the market may be turning against us, and being able to make that decision. So the SSG really can help you with those decisions that you make. It was developed back in the 1940s and the 1950s by one of Better Investing's founders, a man named George Nicholson, who was really interested in democratizing Wall Street and making it accessible to Main Street. From the epicenter of his world in Detroit, Michigan, this was a perfect opportunity for blue-collar workers to learn about investing by investing in investment clubs, joining investment clubs, and learning to analyze stocks back at a time when data was very limited, when calculators and computers didn't exist. And so this was a tool that didn't require you to go to business school, didn't require you to have an accounting degree, and you could make decisions about individual companies. It's really, to me, the beauty of this method lies in the simplicity and accessibility. And simplicity does not mean that it's not that it is an unsophisticated method. It's just boiled down the essence of what makes a good company and allows those investors who are studying that company to make decisions about the right time to buy those particular companies. If you are experienced using the Stock Selection Guide, and we do have professional analysts and money managers who do use this tool as a way to support their investment decision making, there are plenty of ways that you can provide deeper insights and experiences into the tool. And that original 2-page paper form that people used colored pencils and rulers to complete back in the 40s and 50s and 60s and 70s and even into the 80s has now been supplanted by an online web tools app that's included with Better Investing membership and also includes data on 8,000 companies. Now, the underlying framework of the Stock Selection Guide is a discipline that demands some basic criteria, and there are 2 key criteria that companies must meet in order to be analyzed using the model. One, they've got to be well-run, successful companies. They've got to have drivers in place for future growth. And there's a lot of research that you need to do about a company that goes beyond a simple form or a simple application to understand the business, to understand what the management is telling you after their earnings calls, what's the addressable market, what are the drivers, what are the headwinds, what are the tailwinds to the business, how is that all going to play out from quarter to year over time. So we look for companies that have a track record of growing sales and earnings. We look for companies that have exemplary profit margins. There's a strong quality overlay to our GARP approach, where we're looking for leaders on the profitability side compared to peers and industry averages. And obviously, we're looking for companies that are expected to continue their growth trends, that we don't see any serious pitfalls or obstacles in the next 5 years, say, that would impede this company's progress. But beyond finding a good company, we want to buy them at the right price. And it's perhaps that Midwest ethos that's crept into the tool, where Midwesterners don't want to spend more than they have to. And that practice, when applied to portfolios and individual stocks, means you want to buy stocks when you've got a maximum rate of return potential and not overpay. Just because everyone else is jumping on board a stock doesn't mean that it's a good opportunity at its current price. So we look at PE ratios, compare them to the company's history, compare them to the industry averages, compare them to the market, compare them to what we expect in the future if PE ratios have been contracting or expanding. And we also consider the downside and the upside and compare the two, so that we always have much more on the upside than the potential downside. If a company's growth stalls, the price falls, what would that downside be? And try to get in the ballpark and give us a better understanding of that individual company. So the stock selection guide doesn't work on any company. It will give you some insights perhaps, but like any tool, it only works when you use it properly. It's not a drill that you can use to hammer nails. It works to look at companies following that GARP model, companies that are profitable, which means they're not losing money, which means that they have been earning profits for some time, at least a couple of years. If they're consistently growing, we value that. It's very difficult for company managers to grow their business at a consistent level year after year after year. If they're erratic, if they're opportunistic, if they have no kind of guiding principles, those types of businesses tend not to withstand the test of time. We don't look for turnaround opportunities. We're not opposed to fallen angels, those companies that have performed well and maybe merely have tripped up, but we like it when there's still some concrete evidence that their business is sound. We like buying companies that are reasonably valued, kind of following Warren Buffett's admonition to buy, it's better to buy a great company at a fair price than a fair company at a great price. So we're not demanding that every stock be at a 30% markdown. We like to pay a reasonable amount as long as our return potential is there. And importantly, the stock selection guide is not a replacement for stock research. It's an aid to judgment. It's a tool to help you make better investing decisions. Many public companies don't fit the model. I would theorize that there are perhaps 300 to 400 companies publicly traded in North American exchanges that have enough of a track record that can be reasonably analyzed using the stock selection guide. And of those, hundreds of them are going to be overpriced because they will be popular, they will be known to investors. But as always, discipline is the key. If you're disciplined, if you accept the model, if you believe in it and you use it and you don't stray from the discipline over time, this approach does work. As Peter Lynch in the 1990s was writing about his growth at a reasonable price approach, it was very much aligned with the stock selection guide. In one of his books, he actually did include mentions to better investing, and the stock selection guide as a tool that he thought was particularly apt for individual investors. The SSG works because it follows established principles. It doesn't invent new ratios. It really is looking at companies the way management does. It gives you insight into fundamentals without having to interpret hundreds of ratios or pages of financial statements. And that's really part of that democratization that I mentioned earlier, to make it accessible, to make it possible for anyone to utilize the tool. And the key concepts are adaptable to recessions and bear markets. And the more you're experienced you are about investing, and the more that you've been through these cycles, and you learn what happens during a recession, during a bear market, and you learn that when the market has a sudden reversal, that you don't panic sell, and perhaps you go shopping instead. Those types of concepts over time can really help boost your particular returns. Now, our investor advisory service newsletter, we have a team of chartered financial analysts, or the CFAs, that use the stock selection guide. So these are professionals using this tool, and over the course of the past 20 to 30 years, they have delivered results for a stock newsletter among the top of all newsletters tracked by Hulbert Ratings. We've been named to the Hulbert Investment Newsletter Honor Roll for the past 15 years in a row. And as of May 31st, the Investor Advisory Service is the second best performing newsletter that Mark Hulbert tracks as part of Hulbert Ratings for the trailing 12 months. So that's been a very positive development. And I like to point to this and say, this is what happens when you have a disciplined approach and you employ it, and you follow it, and you stick to your guns through thick and through thin, through bear markets and bull markets. You can reach that level of outperformance. So the SSG is all you really need to analyze companies according to our perspective. That KISS principle is something that a lot of investors find useful. You don't have to be doing so much effort in researching a stock that by the time you reach your conclusion, the stock is outside the buy zone, right? So having a simple tool that you can at least get an idea for, and then use your time to do the deep dive, the research, read the earnings releases, read the conference call transcripts, read the company's investment presentation, and learn about the business as an owner of the business would. But if you're experienced, we have many of our users who like buying and selling options, but they use the tool as a framework to gauge the fundamental soundness of those companies. We have users who like to use technicals to help them time their entrance and exit prices on top of it, but they know that the company is solid, so they're just trying to optimize and gain a little bit of extra return by using some technical indicators. Now, the SSG can't be used on mutual funds or ETFs, but I think a lot of users, once they understand the principles behind what makes a successful company, then also learn what makes a successful mutual fund or a successful ETF. Those same principles, I think, go a long way towards helping you make better decisions in that area. So let's take a look at the stock selection guide. As John mentioned, that AAII is a company that we track in our small cap informer, and this is the growth and quality analysis part. This is what you see when you enter a ticker symbol as a member. You get all of the data completed there. The graph shows you at the top, the green line is revenues. The pink or magenta line is pre-tax profit, dollars. The blue line is earnings per share. And then you'll see the high and low price bars. And so you can, with practice, learn to understand what's going on with the company's profitability. If the earnings are growing faster than pre-tax profits, that's a sign that perhaps the company is buying back shares. If earnings and revenues are not growing in concert, maybe that means the margins are declining and the sales are growing faster than earnings. And likewise, if earnings are growing faster than sales, perhaps the margins are increasing, which can also be a good sign. You can intuit the PE ratios by the intersection of earnings per share and prices. So to see where the current price is relative to the past will also help you with the decision making. Now, AAII is a Brazilian medical education company. Why Brazil? Brazil is an enormous emerging economy, and they have a shortage of medical professionals. So there's a huge market for growth there. FIM operates medical schools, but also beyond that, they have a digital universe for continuing education, for physician resources that are all available. So their model is we get the students connected to our ecosystem when they enter medical school, and then because they need to continue with their studies, with continuing education, even after they graduate, they are lifetime customers of the business. And so this is a company that probably doesn't come up on too many radar screens, simply because it is Brazilian. They do trade on a U.S. exchange, so they report in the Brazilian currency, but you can find the financials that have been converted to currency. I will also point out that investing in companies outside the U.S. brings with it political risk, currency risk, etc. But this is a small company that perhaps could be part of that small, more speculative portion of your particular portfolio. So from the graph here, the next step, the 10-year graph here, company goes back to 2017, but you'll see there's 3 years rather, of future fiscal year sales and earnings estimates. So a lot of that data is provided from included with the data, but you can also get perhaps more earnings estimates from Zacks and from Seeking Alpha and a number of other websites. And the importance here is, when they're plotted on the graph, it gives you a sense of analysts expect growth to continue at this company for the next several years, and essentially in line with how the growth has been in the past. And that's what we like to see: consistent growth, not a lot of fluctuation, a little bit in 2020, 21 in terms of the earnings and profitabilities. We all know what happened back then, but we also see that analysts are pretty optimistic about it, and that's what we like to see. Once you've reviewed that, we're going to make a projection of what we expect the likely growth of earnings and sales to be over the next 5 years. And so again, there is analyst data that's available. In this case, our data provider Morningstar provides a consensus 2-year sales estimate of 9.8% a year, and the long-term growth rate estimate from Zacks is 18.6% for earnings per share. So there is growth here. This is not going to be a momentum stock perhaps, or the fastest grower, but it is growing faster than the Brazilian economy, faster than the US economy, and potentially there's some opportunities here. If we discovered through our research that analysts were expecting flatline growth over the next couple of years, that might turn our opinion. If we expect growth to kind of continue to slow, or was starting to slow, we might take that under consideration. But if we're conservative, we can get in the ballpark of what the results are likeliest to be for this particular company. If we scroll down, you'll see the fundamental data is there, but also at the bottom, there's a table of pre-tax profit margins, which is one of the most important things that I like to look at. And you can see the trend over there. You can see the actual data, the percentage pre-tax profit. We look at pre-tax profit. It's especially useful for a company like this, which is not a US company. So if we looked at net profit margin after taxes, we would be comparing a company paying Brazilian corporate income tax to a company paying American corporate income tax, and that's not a very fair comparison. But if we look at the pre-tax margins, we can compare this company to other businesses in the same industry, in the same sector, no matter where they are in the world. Prior to the last round of corporate tax reform, tax rates were, and there were more tax credits available, so the actual tax rates that companies paid could vary significantly. That's less of a concern now, but there still is a commonality of comparing pre-tax profit margins across the board. We like the trend to be up. We like companies that are increasing their profitability, or at least stable. If the margins are going down, we want to understand why that is. It could be competition, could be cost of raw materials, company's not managing. Could be labor costs, energy costs. You know, all those things kind of all trickle down to the profits and then down to earnings. And so it's a good measure of the health or quality of a particular company. There's a lot more on the screen of recent quarterly results. You can add on the graph. You can look at book value and free cash flow or dividends and debt if you wanted to. But we're going to focus on the basics right now. One of the interesting parts of the tool is the ability to compare companies to their peers and competitors. So in this case, we're comparing the company to Legacy Education and Quata Singh Group, ticker QSG, and you can see we can go across the top. You can look at the sales and the earnings and the pre-tax profit. I'm looking at that pre-tax profit margin, the percentage pre-tax profit on sales, and there you can see that all three of these companies are seeing their margins go up. AAII's are the highest margins of the group. And again, we like that. We like it when companies are leaders and that provides, again, a little bit of a margin of safety. So this is an important part of the program. As we scroll over, we're looking at the valuation section now. We've got a table up at the top here of PE ratios. So you can see some of them have been X'd out. I've removed some of them as outliers. I'm looking to see what's the average highest margin of each fiscal year and what's the average PE ratio of each fiscal year. What's the lowest PE ratio of each fiscal year and what's that average over the period there. So I tend to remove some of the higher ones because that elevates the high PE ratio and elevates the low PE ratio. Also compare the current PE ratio to the overall average. So that bottom row of that table there to the left of the orange box, the current PE ratio is 13.2. The average, the adjusted average in this case, is 15.3. So that's jives with what John discovered, that perhaps this is an undervalued opportunity. The PE ratio is a little bit low relative to the company's historical past. And you can see the trend there. PE ratio is kind of coming down over the last few years, but at some point those are bound to stabilize as the company continues to make gains, as it grows its business, as it improves its profitability. If the company pays dividends, and this company actually just started paying dividends, but they're going to pay them on an annual basis, not on a quarterly basis, on a variable basis, as many non-US companies do. But that's another aspect of it that you can consider there. You can see the table says dividends, the payout percentage, and the high yield percentage. So if you bought it at the lowest price, what would be the highest yield for the year if you are interested in that yield component of total return. So far, we've been looking at the valuation, the growth and the valuation. We'll scroll down. There's some more decisions to make, but it's all pretty much basic math. We're going to figure out what we expect the highest PE ratio the stock is going to sell at in the next 5 years, based on the history, based on what we know about the industry and PE ratio trends within the industry, based on what we know about the market. We're going to select and try to be conservative with what we expect that high PE to be. In this case, I've selected a high PE of 19.4 and the high earnings per share that, if the company grows as I expect, should be around $2.55, which would give you a high price in 5 years of $49 from the current price of about $17.50. So that's a pretty good rate of return. But as we go down, we're going to look at the low side as well. We're going to say, well, what's the lowest PE ratio we reasonably expect the company to sell out in the next 5 years? In this case, it's 11.2. The earnings for the last 4 quarters is 132. So that gives us a low price of $14.80. So pretty small drop from the current price of $17.50. So in other words, not as much downside compared to the upside for this particular company, and that's what we like. And it could, of course, the stock could always breach that low price selection if something unusual happens, but we're not looking to capture every event. We're looking to capture the company merely is chugging along as it has been, and the market is doing what the market does, which is varying up its assessment of the company's worth over time, what would that downside be? So in this case, item C here is the zoning that if we accept those high prices and low prices, the stock is in the buy zone. The upside downside ratio, almost 12 to 1, so 12 times the upside to 1 on the downside. That's pretty aggressive. I wouldn't necessarily count on that. I might revisit this a little bit and scale back my earnings growth. But at any rate, it's giving us an indication that this could be a good opportunity based on the fundamentals and where they stand at this time. We scroll down again and the computer does the calculation. There's about a 1.3% current dividend based on that new dividend that it's paying. So that's a little extra return. And the annualized rate of return, if the company does grow from $17.50 to that $49 price, would be a 23.1% annualized rate of return. So we like to see companies that have a better than 3 to 1 upside downside ratio, total return better than 15%. So we wanted you to beat the market plus a little extra. Again, margin of safety, even if it doesn't deliver 23%, if it delivers 18% or 16% over time per year, we would be quite happy with that. And the stock is in the buy zone. So it may be a buy. It's not definitely a buy. The tool does not speak to you. It does not say that it's a buy. It merely suggests that based on your analysis, this stock looks like it could be an opportunity. Do the rest of the research, complete your due diligence before making an investing decision. One more quick view here of the quarterly trend graph. I'm going to show you another view after this. This is, again, a way of looking at sales and pre-tax profit and earnings and the profit margin on a quarterly or on a trailing 12-month basis, trailing 4-quarter basis. Again, looking for trends. So we do see a little bit of this margin on a quarterly basis. It is sliding a little bit, but as we noted, compared to the competition, it's still much better, at the top of the heap for similar small-sized companies in this particular industry group. So gives us, I like to think of this as a, the main graph tells you what the company has done, and this graph gives you an idea of what the company has done lately. So it gives you a little sense of how perhaps in the last 1, 2, 3 quarters since the last fiscal year, has the company continued to make progress at its fundamental goals. And then finally, one of the things that more and more of our members are finding quite useful is member sentiment. This is a collection of everyone who's been studying this particular stock with their judgment items. So what is the growth rate that they are using? What are the PE ratios that they've selected? And what is that? In this case, I'm looking at the total return. So the mean total return, 24.7%, the median, 24.1%. The graph on the right gives you a sense of, there's only a few people following this particular company, but it gives us a sense of the distribution of returns based on other users. And so a lot of optimism kind of built into this particular stock study based on these. Everyone is looking at 15% or greater return per year, which would be a good opportunity for just about any particular company. So with that, again, we're going very quickly, kind of giving you an overview, but we wanted to look at a specific company as a way of demonstrating the tool, giving you an idea of our process and how it is employed in the real world. But we're happy to answer any questions that you might have now. John mentioned some of the offers that are available. The handout has more of the details. We do have a special offer for those of you who belong to AAII. And by the way, I am a lifetime member and have been since the 1990s. But if you're interested in checking out AAII, we have special savings there for new members, and we also have discounts for our 3 newsletters. Many of you may be familiar with our investor advisory service and Small Cap Informer. We've certainly presented those at AAII conferences and at local events in the past, but we'd like to, love for you to check those out. And you'll find more. We'll be doing some follow-up emails. We'll tell you more about everything that we have to offer, and hopefully in future webinars, we'll be able to demonstrate even more some of the ways that you can leverage all of this resources and information from the 2 organizations to help you become a more effective and investor over time.
That's great. And I posted the both of the offers, the AAI offer and the Better Investing offer, in the chat, so you have those easy access, and the links are in there as well. Let me take a look at a couple questions. So one right off the bat is, I think it's directed mostly to John, but Doug could also talk about SSG and Better Investing as well, kind of perspective on it. But we got a couple questions asking, how can I pick stocks or follow stock screens when politics is driving the market? Are there screens that cut through the noise, or ones that lean into more political momentum?
Well, I think none of them specifically probably lean towards political momentum. I mean, I think government risk is probably there all the time. I mean, you look at the changes in oil prices or whatnot, or commodities, or Bitcoin, that could be influenced by government risk. I mean, the thing about these approaches that we're talking about here, they have a very specific framework to make decisions. This is a decision framework that is sort of agnostic, and you could take into account perhaps the impact that political risk may have on a growth rate of a company or on an industry or things of that nature. Obviously, it's impacted the solar industry, but I mean, these are to the extent that it changes your growth rate, that's going to change your valuation. I mean, if you are looking at perhaps a momentum-focused approach or stock screening approach, like a Cancelam approach, which looks for stocks that are hitting new highs and are showing quarter-over-quarter earnings growth, that's going to be probably a little bit more timely. It's going to be stocks that are perhaps more desired by investors today. So that could be perhaps more timely. But again, it's a framework, consistent framework that you could use throughout different administrations, and it's been proven to work in the past. Like any approach, there can be times where individual stocks or approaches go in out of favor, but it's a framework to make a decision, and hopefully kind of ignore some of the emotions that drive can drive us in the wrong direction. I'm not sure if you have anything to add on that, Doug.
Yeah, no, I'm with you entirely. One of the advantages of a long-term approach is that you don't have to worry about what's happening today, tomorrow, this week, what's driving the market this year, and just like bear markets, just like recessions and expansions of the economy, just like the bull market cycles, the political cycle will run through, and there will, you always see every time there's a change of presidential administration, there's going to be a media story on here are the 10 stocks to buy for the next presidential administration, and at the end of the day, are they really going to benefit the stocks that people expected to get uplifts and expected to not perform well in February or March are not the same ones that actually did perform well or didn't perform well. So all sorts of uncertainty in it. The advantage of a long-term approach is if you can turn off the media and focus on what drives a business over time, and if you understand that an executive team of experienced professionals running a business, you're going to let them handle the tariff issues and the cost of goods and the labor costs, and if they're a good management team, they're going to be successful no matter what. They're going to tackle those obstacles that are thrown at them, and they're going to thrive, and they're going to come out on the other end. And so that I put a lot of stock in that quality metric, that quality focus, looking at that element, because I think that is provides that margin of safety, and I've used that term a couple of times. As you know, Warren Buffett loves the margins of safety, but it gives you that little edge to help you hopefully sleep better at night and not wake up, in a panic. And I always say, if that's what's happening, I think the problem is your approach to the market isn't jiving with your personality. If you're so worried about it, or the where you are in your personal life cycle isn't jiving with how you've constructed your portfolio, that's a completely different matter.
That makes sense. And actually, we had a couple questions from multiple members asking, does AAII or Better Investing use AI in their tools? Is there any plans to? I know with the AI boom, and I think everybody has the same kind of questions on the mind. So I'll direct to Doug first, and then John can answer.
I think we're still a little ways off from a lot of the implementation that people are kind of fantasizing about in terms of the investing realm. And the last thing you want is an AI agent hallucinating about the stock analysis questions that you've thrown at it, and come back to you with something that's not based, that's really not grounded in reality. So we're watching the trends. We're using AI behind the scenes, primarily from a content perspective. I find it quite useful to feed in a conference call transcript and say, summarize this, in 2 paragraphs. Or try to do textual analysis, and I found that to be useful. But we're still, we'll see where this is all going. It's all kind of interesting. I will point out that we've been through cryptocurrency, we've been through blockchain, we've been through a lot of technological trends in the last 20 years that have not panned out. So I think having an open mind and continuing our investigation of AI as it's developing will be just part of the aspect of running the organization.
Yeah, building upon that, I think AI in many forms has been around really since for as long as computers have been around. I mean, however you define it. I mean, the current obviously acceleration has been with the large learning models, and in that context, I know we're looking at we've developed a large resource of information. We've been publishing information for 40 years, and how do we take those articles that have relevant content and use perhaps an AI engine or a bot to help answer people's questions? So in that context, we are looking at how we can go ahead and use an AI engine for someone to ask a natural question, and then have it search our archives and point them to the articles that are of interest, summarize it, but point to, because I think it's important to add, as Doug said, I mean, the issue of hallucination or wanting to please you is a concern. That's the primary purpose. We've used it as well to help illustrate how to do form equations and whatnot. We've got a series of articles in the journal talking about the use of AI as an investor, how you could use it to harness some of your tools. Those are probably the things that are most interesting, is its ability to summarize information quickly and accurately.
Great. And let's see, I'll just pick one more because I know we're running a little bit over. So this is directed to John. Can combining multiple stock screens on fundamentals like value or momentum quality actually improve results, or just create kind of conflicting signals?
There are certain factors that tend to complement each other. And I think we've seen a lot of complements between having value and momentum as a combination. I think you always want a certain level of quality. I mean, some factors probably by using them help you avoid really bad investments. There's a lot of value to avoiding the trash. I mean, you could improve your small cap rate of return, your micro cap rate of return, by simply ignoring the non-profitable companies. I mean, for some of these factors, you probably only want to have a minimum quality of a minimum grade. So you want to have minimum quality, perhaps a minimum level of earnings of growth. so you probably are talking about having a company that's well balanced as opposed to having a very high, very low value or very high growth. And what we found whenever we've done back tests of companies that have had extremely high levels of either past growth or expected growth, those typically go on to underperform the market because expectations are too high for those firms. And they typically they revert back to the norm. So I think there's an advantage to looking at not necessarily the extreme points, but having companies that are reasonably valued, like a growth at a reasonable price approach type thing. I think that seems to be the sweet spot where companies are attractively valued consistently. But I mean, if you go deep value, you want to make sure you're not getting into a value trap. So you want to have the quality there. And sometimes the price momentum helps to find those companies that are low priced, but all of a sudden there's some investor sentiment or interest in those companies or some catalyst to do some research on that. So there is, I think, some value to combining them.
And before we wrap up, and I'll share the special offers as well as some important information, I'd like to give Doug and John a moment for some closing thoughts. I'll start with you, Doug.
Well, I see that there have been some questions about what are we doing? What is this? When are we going to do this again? Yeah, our plan is on the fourth Tuesday of each month. We're going to be exploring topics, so please let us know what you'd like to see. We'd love to have some feedback, and we think there are a lot of synergies between the organization and the two organizations, and so we're excited to be part of it and have these conversations. And I look forward to continuing our presentations and our webinars, and really getting to some meaty topics, and let's duke it out over various some return ratios and what's important and what's really important, and you really think value and momentum is the way. Let's explore all that's out there and hopefully contribute to the ongoing education of the members of both organizations.
Yeah, looking forward to it as well. I mean, I know that the Detroit Tigers, and I know that Better Investing is based out of Michigan, and perhaps Chicago Cubs, although I think they've been struggling lately, might have good years this year. I think we'll have a chance to follow those teams this fall. But I'm looking forward to opening this conversation, and I think exploring the tools and understanding how best to make investment decisions. And I mean, I think. No matter what, I think education is the tool that really helps us reach long-term goals effectively. When the market is down and you've experienced an understanding of, well, one should expect a small correction every year, a 5% correction every year. I mean, that's just part of investing. One should expect a bear market every 3 to 5 years, and the markets always come back. I mean, the education and understanding of history and how to use tools arms us in a way that we could keep our intellect going and making the decisions, and kind of not letting our emotions drive us aside. So I think this is a great opportunity to explore tools of interest to the individual investor.
I couldn't agree more. Well, first off, I want to thank both of you, John, Doug, for guiding us through how to use both AAII's and Better Investing's complementary tools and strategies. I know I learned a lot. I think the audience did. And if I saw a lot of questions still coming in about logistics or offers and things like that. So if you have questions about AAII tools or services, feel free to email us at members@aai.com, or you can call us at 312-676-4307 Monday through Friday, 8:30 a.m. to 5 p.m. Central Time. I put that information also in the chat. And then if you have any questions for Better Investing, please direct your questions to service@betterinvesting.org, or you can call them at 877-275-6242. And then now for our two special offers, I've been kind of sprinkling them in the chat, but if you miss it, if you had to leave early or something like that, we'll email all of these offers directly to all the attendees today. And they are exclusive to webinar attendees. So you can save over $100 on AAII Plus, which includes our 3-in-1 stock fund ETF toolkit, as well as all the benefits of AI membership, access to our journal, our model shadow stock portfolio. So you can access this promotion. Please visit AAII.com/betterinvesting. And then, as Doug had outlined in his presentation, Better Investing is also extending a special offer on their membership, and which is now $99 for the first year, regularly priced at $145. And then to access that deal, please visit betterinvesting.org/AAII, and you can enter the promo code AAII at checkout. And then lastly, this presentation was recorded and a replay will be available at AAII.com/webinars later this week. And webinar attendees will receive an email with the link, as well as all the good resources that I put in the chat in the next few days. And with that, we wish all of you viewing good health, good fortune, and a great rest of your evening. Thank you so much, and take care.
Thank you. Good night.